Good morning, everybody. Mike Tedeschi over at Perspective Wealth Planning. In this week's video, I want to take a look at the four major U.S. indexes. I would like to talk about valuations from a Case-Shiller PE ratio. We'll take a look at some breadth readings as well. So let's jump right into it here. The S&P 500 has made a series of continual new all-time highs here over the last few weeks. However, yesterday we started to see that first crack, so to speak, as we dipped below the 10-day moving average for the first time since October 9th. RSI also broke below that 70 zone. And that is one of the things that we pay attention to is a move above 70 and then that move back below 70. A lot of times that is where negative things can happen from. So if we go back in time, for example, take a look at the last few times that we had some stronger sell-offs was after we had a move over that 70 RSI and then broke back below it. Now, it doesn't always happen immediately, as you can see on this one right here. The first pullback or break below 70 RSI was right here. It actually took about another week or two before that actually ultimately played out, and then you had that sharp sell-off right there. So this doesn't mean that we're all of a sudden going to, again, collapse or anything like that. It's just a warning sign saying, look, we were trading above that 10-day moving average for a long time. We've now dipped back below that. Our RSI was above 70. It started to turn over. And again, if we take a look at the MACD here, that histogram looks like it has a potential to flip negative, and we do have a potential for a crossover. It hasn't happened yet. So again, this is just an area that we want to pay close attention to. If we do look at the way this is set up currently, we're above the 10, the 20, the 50, and the 200-day moving average. All of them are pointed up. That is still a trending upward market, and that is something we have to continue to keep in mind as well. NASDAQ, same type of behavior, same type of action out of RSI, same type of setup on the MACD, same type of setup with the 10, 20, 50, 200-day moving average, all pointing forward. We come in here and we take a look at the Dow Jones industrial average here as well. Same type of setup above that 70 RSI, sitting right on that 10-day moving average. MACD looking like it has a potential to cross over, and histogram has the potential to flip negative here for the first time in a while, but it is still above the 10, 20, 50, and 200-day moving average. Of course, the different one is the Russell. So when we take a look at the Russell, we are at that 10-day moving average. The 10 is above the 20, which is above the 50, which is above the 200. That finally happened here over the last week or so, where we have all of the moving averages lined up for the first time in a while. However, the histogram and the MACD have flipped negative as of a week or so ago. So if you notice kind of what I've drawn on here, we have the potential for this being a I'll clear all these drawings out for 1 second and redraw it so you guys can see it. We have that major resistance that we've talked about right here. We have moved up now for the last 2 months, and then we have started to base. And if you look at what that potentially looks like, that is what a potential bull flag would look like if it were to break out of the top end of that zone. We would have that potential to have that move to the upside. And again, this is an area of the market I've continued to talk about. I think it's a key. I don't think we have a really good opportunity for the rest of the indexes to continue to rocket higher without participation from the mid and small caps. So what happens right here may be the most important signal for me here moving forward over the next couple of weeks. If we do get that break on the Russell here to the upside, I think that would confirm that we have a good potential here for a strong finish to the year. If we once again fail right at this zone and roll over, again, we've just seen the Russell trapped in a range now for 2 years. Really, the majority, again, of the trading has happened inside of this range. So outside of a couple of months where we had a move to the upside and a move to the downside, the Russell essentially has just traded between that 1450 and 1620 level now for the better part of 2 years. So again, very important to pay attention to what happens here. Also want to jump in here and take a look at the emerging markets. So we'll take a look at MXEF, the emerging market index, right? We had that downward channel that we talked about make that breakout here. It is continuing to drift here to the upside. The really important level is still at 1100. And one of the things that you will notice here when we look at this on a daily chart is that the 10 is above the 20, which is above the 200, and the 200 is above the 50. These are not quite aligned yet, so you need the 50 to move back up over that 200 and that 10 to stay over that 20 to have all of those time frames aligned. That's still an issue here out of the emerging markets chart, and you can see we have failed right there at that major resistance level again, right around that 1100 zone. Um, and so really, when we're paying attention inside of the emerging market index, we need to get back up over 1100 as well. It's very difficult for us to rally 10, 20, 30% higher without the rest of the world subsequently also kind of joining suit and at least rallying somewhat. So this major resistance in on the emerging market, I believe, is also important. Now, one of the things I wanted to talk about is valuations. One of the things to look at is the Case-Shiller PE ratio. And right now, as it sits, the Case-Shiller PE ratio is at 30.22. The mean is 16.6. The median is 15.7. So we are basically about double the average in terms of the expensiveness that the market is at. So the Case-Shiller PE ratio is the price to earnings ratio based on the average inflation adjusted earnings from the previous 10 years. And so when we look at the Case-Shiller PE ratio, there's really only 2 times in history we have at this level or higher. 1929, Black Tuesday, we were right around that 30 PE ratio level, and then during the dot-com bubble, we ran all the way up to 45. And so right now we're sitting at 30 again. So historically a very expensive market, and that of course is something that is a concern for us. But when we talk about what happened in the 90s and in the beginning of 2000, we were above that 30 PE ratio for about 4 years before it actually topped out at 45. So this is not saying the market's going to crash tomorrow by any stretch of the imagination. All this information is really telling us is historically the market is expensive, but that doesn't mean that it can't continue to stay expensive or get even more expensive from a PE ratio standpoint over the next couple of years. So it's not a reason to go out and sell stocks or anything like that. It's just another thing to kind of put in that column of reasons to be cautious. And when we talk about reasons to be cautious, let's take a look at the NASI breadth indicator. You guys will notice I talk about this in almost all of my videos. It's because I really feel that this is a very important indicator to take a look at. It does a really good job of short-term kind of showing where headwinds and tailwinds ultimately show up in the market. And what we were talking about before is we had this line drawn right here as a potential resistance zone going back to that bottom here of April in 2019, and we did not want to see us essentially fail right in this zone. Right in here is kind of that resistance area. And of course what we've seen here over the last couple of weeks is the breadth reading stopped rising and we started to get that potential turnover, and over the last few sessions we actually do have that crossover, and so this is something we're paying very close attention to. Now this doesn't mean that this is all of a sudden going to fall off a cliff. If you notice right in here, right, we had a crossover, then it crossed back over, and then it ultimately went like this. So there's nothing to say that this can't do something like this. It's just we got to pay very close attention here, because if we do see it really start to turn down over the next couple of sessions, that would be a good indication that we were probably headed back down into this zone, and subsequently that would mean some headwinds for the overall markets here over the next week or two, which would be very important. Last thing to talk about, next week is a holiday shortened trading week, Thanksgiving. We rarely in this country see a large market corrections into holiday shortened trading weeks. Most of the major players subsequently take off more time around those holidays, and we see a lower amount of volume and volatility kind of dry up. That doesn't mean it can't happen, but typically speaking, when we look at holiday shortened trading weeks, we don't have to necessarily worry about large market corrections. Now, of course, you know, that's history, and that could certainly change with this upcoming week, but when we go back and we look at all the data, really holiday shortened trading weeks are lower volatility, lower volume, and smaller moves historically speaking. So to kind of sum up here today, guys, we continue to rock and roll higher. We have all of the moving averages pointed in the correct direction, but again, we're starting to see some potential short-term reasons for us to get some pullbacks here. Breaking below that 10-day moving average, seeing RSI drop under 70 for the first time in a while, the potential for those MACDs to cross over, and then of course we have the NASI breadth reading starting to show that crossover, and always in the back of our mind the high value that the market has subsequently put on stocks against a historical basis. I hope you guys have yourselves a fantastic week. As always, I'll see you guys next week. Take care.